Warren Buffett's Ground Rules by Jeremy C. Miller. Imagine this scene. It's 1956, a quiet evening in Omaha, Nebraska. 7 people are gathered for dinner at a local club. A few family members, a couple of close friends. At the head of the table sits a young man, just 25 years old, with an earnest face and an unusual proposition. He's not some Wall Street hotshot. He's just a kid from the Midwest who recently returned home after working for his hero, the legendary investor Benjamin Graham. These 7 people have decided to trust him with their money, not a fortune, just over $100,000 total. But before accepting a single check, he hands each of them a short, typewritten document. It's not the formal legal paperwork. He tells them not to worry too much about that boring stuff. This document is far more important. He calls it his ground rules. And these rules are, well, pretty demanding. He tells them he won't be sharing stock tips. He won't tell them what he's buying or selling. He demands complete freedom to make decisions. He tells them they can only add or withdraw money once a year. And most importantly, he defines success in a way almost no one else did at the time. Success wasn't about making money every single year. It was about beating the market over the long haul. He ends by saying, "If you're on board with this, then let's go. If you're not, I totally understand." That young man, of course, was Warren Buffett. And that small gathering marked the birth of an investment partnership that would achieve legendary results, growing money at a rate that baffled the experts, and turning that initial $100,000 into over $100 million by the time he closed it down 13 years later. He never had a losing year. The book we're exploring today, Warren Buffett's Ground Rules by Jeremy C. Miller, is an absolute treasure. It's the first time anyone has gathered the wisdom from those early, private partnership letters that Buffett wrote to that small group of followers. These aren't the famous, widely read Berkshire Hathaway letters. These are the raw, foundational lessons from a young Buffett, working with small sums of money, just like you or me. This is where he forged the principles that would make him the greatest investor in history. So what's my promise to you? By the end of our time together, you won't just know what Buffett did. You'll understand how he thought. You'll have the mental toolkit he built, piece by piece, to navigate the chaos of financial markets. This isn't about complex formulas or Wall Street jargon. It's about a timeless philosophy, a set of ground rules for investing and for life that are just as powerful today as they were in that Omaha dining room more than half a century ago. Let's dive in. To truly understand Warren Buffett, you have to first understand the man who shaped him. His name was Benjamin Graham. Graham wasn't just an investor. He was a revolutionary. In a world where Wall Street was seen as a high-stakes casino, Graham turned investing into a profession, a discipline built on logic and reason. He literally wrote the book on it, a masterpiece called The Intelligent Investor. When young Buffett discovered that book at the University of Nebraska, it was like a lightning bolt hit him. He read it not once, but half a dozen times. It was so profound to him that when Harvard Business School rejected him, one of the luckiest things that ever happened to him, he discovered that Ben Graham himself was teaching at Columbia University. He immediately applied, was accepted, and soon became Graham's star pupil, the only student to ever receive an A+ in his class. After a few years, Buffett finally landed his dream job working for Graham. But when Graham decided to retire, a 25-year-old Buffett returned home to Omaha, not to sell stocks for his father, but to start his own small investment partnership, modeled on everything he'd learned from his mentor. So what was the single most important lesson Graham taught him? It's an idea so simple, yet so powerful, that it forms the bedrock of everything Buffett has ever done. Graham created a character to explain it, a quirky, moody business partner he called Mr. Market. Imagine you own a small piece of a wonderful private business, and every single day your partner, Mr. Market, shows up at your door. The thing about Mr. Market is that he's extremely moody. Some days, he's euphoric. He sees a glorious future for the business and offers to buy your share from you at a ridiculously high price. Other days, he's utterly depressed. He's convinced the business is doomed and, in a panic, offers to sell you his share for pennies on the dollar. Most of the time, he's somewhere in between. The crucial thing to remember is this: you're under no obligation to do anything. He's there to serve you, not to guide you. If his price is foolishly high, you might consider selling to him. If his price is foolishly low, you might consider buying from him. But the rest of the time, you can simply ignore him and focus on what truly matters: the long-term performance of the business itself. This simple story reveals a profound truth. The stock market, with its frantic moment-to-moment price swings, is Mr. Market. It offers you prices every second of every day. But those prices are driven by the collective emotions of millions of people, by fear and by greed. They're not always a reflection of the true underlying value of the business. An investor's job is to figure out that underlying value independently, and then use Mr. Market's mood swings to their advantage. You never ever let the market's daily noise tell you what a business is worth. As Buffett would later write to his partners, the availability of a quotation for your business interest should always be an asset. Its availability should never be turned into a liability where its periodic craziness starts to shape your judgments. This leads to the second core principle from Graham: a stock is not just a little piece of paper to be traded back and forth. It's a fractional ownership claim on a real business. When you buy a share of a company, you own a tiny piece of its factories, its brands, its people, its future profits. Therefore, the only way to invest intelligently is to concentrate on the business, not on the squiggly lines of its stock chart. As Buffett explained it, the course of the stock market will determine, to a great degree, when we'll be right, but the accuracy of our analysis of the company will largely determine whether we'll be right. In other words, focus on what should happen, not when it might happen. This is why Buffett has always been so dismissive of market predictions. He made it one of his original ground rules. I'm not in the business of predicting general stock market or business fluctuations. If you think I can do this, you should not be in the partnership. He knew that the short-term future is unknowable. There are simply too many variables. He often quoted his mentor Graham, who used to say, "Speculation is neither illegal, immoral, nor fattening financially." Buffett taught his partners to embrace an "I don't have the first clue" mindset when it comes to short-term forecasts. It frees you from wasting time on things that cannot be known and allows you to focus on what can be known, the analysis of a business. Who would sell a farm, he might ask, just because they heard a forecast for a dry summer next year? You own it for the long haul. You should own your stocks the same way. And part of that long-term mindset is preparing yourself emotionally for market pullbacks. Mr. Market will inevitably have his dark days, his moments of panic. Buffett was clear with his partners from the start: market drops are inevitable. He wrote that if a 50% decline in the value of your portfolio is going to cause you real financial or emotional hardship, you simply shouldn't be in stocks. That's the price of admission. But for the long-term investor, these drops are of little consequence. They're opportunities. Because we understand that the quote Mr. Market offers is an asset to be used, not a verdict to be feared. We can be buyers when others are fearful, knowing that over the long term, the market's general trend is up. These foundational ideas, seeing stocks as businesses, using Mr. Market as a servant, ignoring forecasts, and embracing volatility, are the intellectual toolkit Buffett inherited from Graham. But it was what he did with these tools, powered by another, almost magical force, that truly set him on the path to becoming a legend. That force is compounding. It's been said that Albert Einstein called compound interest the eighth wonder of the world. He who understands it, earns it. Einstein supposedly said, "He who doesn't, pays it." Buffett grasped this concept in his bones from a very young age. He knew, with absolute certainty, that it was going to make him rich. An investment program, at its very core, is a compounding program. It's the process of reinvesting your gains, so that your gains start earning their own gains. It's a snowball rolling downhill, getting bigger and bigger, faster and faster, with every rotation. To drive this point home for his partners, Buffett used a series of humorous historical tales in his letters. He told the story of Queen Isabella of Spain, who financed Christopher Columbus's voyage in 1492 for about $30,000. A moderately successful venture, right? Well, Buffett did the math. If Isabella had instead invested that $30,000 and earned a modest 4% per year, by 1962, it would have grown to $2 trillion. As he wryly noted, the whole deal was not exactly another IBM. Then he turned to the art world. In 1540, King Francis I of France bought Leonardo da Vinci's Mona Lisa for about $20,000, a priceless masterpiece. But what if instead he had invested that money and it had compounded at just 6% per year after taxes? By 1964, that $20,000 would have grown to $1 quadrillion. That's a 1 with 15 zeros after it. Over 3,000 times the entire national debt of the United States at the time. Buffett joked, "I trust this will end all discussion in our household about any purchase of paintings qualifying as an investment." These stories, as whimsical as they are, illustrate two critical points. First, the power of compounding is explosive over long periods of time. And second, seemingly small differences in the rate of return make an enormous difference in the final outcome. The gap between a 4% return and an 8% return over 30 years isn't double, it's nearly 4 times larger. This is why, as investors, every single percentage point matters. It's why fees, taxes, and unnecessary trading can be so devastating to your long-term wealth. They're tiny leaks in the engine of compounding. Buffett's final story on the subject is perhaps the most powerful. It's the tale of the Manhattan Native Americans, who in 1626 sold their island to Peter Minuit for about $24. Sounds like a terrible deal, right? The land value of Manhattan in 1965 was estimated to be around $12.5 billion, but Buffett, ever the contrarian, flipped the calculation. To get from $24 to $12.5 billion over 338 years, Minuit's descendants would have needed to compound their money at a rate of 6.5% per year. A decent, but not spectacular, return. But here's the kicker. What if the Native Americans had taken that $24 and managed to earn just half a percentage point more, a 7% return? That seemingly tiny difference would have resulted in a fortune of $205 billion, far more than the island was worth. The lesson is crystal clear. Every fraction of a percent in your annual return, compounded over a lifetime, creates a colossal difference in your final wealth. This is the central engine of Buffett's entire philosophy. His frugality, living in the same house for decades, driving modest cars, isn't just a personal quirk. It's a deep understanding that every dollar not spent is a dollar that can be put to work in the compounding machine. As his partner Charlie Munger once said, Buffett viewed a $10 haircut as if it were actually costing him $300,000, because that's what the $10 could grow to if invested over his lifetime. So we have the mindset from Graham, and we have the engine of compounding. Now we come to the rules of the road. How did Buffett actually structure his partnership and measure his success? This is where his genius for clarity and integrity really shines. Before he even began, he laid out his ground rules. The most important of these dealt with how he wanted to be judged. Rule number 4 was revolutionary for its time. Whether we do a good job or a poor job is not to be measured by whether we're plus or minus for the year. It's instead to be measured against the general experience in securities as measured by the Dow Jones Industrial Average. If our record is better than these benchmarks, we consider it a good year, whether we're plus or minus. If we do worse, we deserve the tomatoes. Think about that. He was telling his partners, don't cheer if we're up 20% in a year when the market is up 30%. That's a failure. And don't throw tomatoes If we're down 15% in a year, the market is down 30%. That's a huge victory. He was completely focused on relative performance. His job was to beat the average, to be the duck that not only rises with the water level, but also occasionally flaps its wings to get a little higher. His next rule established the time frame. While I much prefer a 5-year test, I feel 3 years is an absolute minimum for judging performance. He knew that any strategy could underperform for a year or two. He was demanding patience. He only made one exception. He told them to expect to lag the market during the final stages of a, quote, speculative explosion in a bull market. He was setting the expectation that he would look foolish right before everyone else did. His goal was ambitious. He aimed to beat the Dow by an average of 10 percentage points per year. He figured the market itself might deliver 5 to 7% over the long run, so he was shooting for returns of 15 to 17%. And he delivered far more, compounding his partner's capital at nearly 24% a year after his fees. He also designed his partnership structure with breathtaking fairness and alignment. This was no ordinary fund. First, he charged no management fee, zero. Today, most funds charge a percentage of your assets, whether they make you money or not. Buffett only got paid if his partners made money. Specifically, he took 25% of the profits, but only after the partners had first received a 6% annual return. This 6% threshold was brilliant. Since he expected the market to return about 5 to 7% on average, he was essentially telling his partners, I don't get paid a dime unless I beat the market for you. And most importantly, he had virtually his entire net worth, and that of his wife and children, invested right alongside his partners. This wasn't a heads I win, tails you lose situation, which is so common in finance. It was heads we win together, tails we lose together. His interests were perfectly aligned with his investors. With this foundation of principles, measurement, and structure in place, we can now turn to the actual workshop where Buffett plied his trade. How did he find these incredible investments? He divided his activities into 3 distinct categories: generals, workouts, and controls. The generals were the bread and butter of the partnership. These were generally undervalued common stocks, primarily identified by quantitative measures. In his early years, Buffett was a pure disciple of Graham's cigar butt approach. He would scour the Moody's manuals, thick, dense books of financial data, page by page, looking for companies that were statistically outrageously cheap. He was looking for what he called net nets, companies trading for less than the value of their current assets like cash and inventory minus all their liabilities. These were often terrible businesses, the soggy cigar butts of the investment world. But they had one free puff left in them. They were worth more dead than alive. One of the few generals he ever discussed publicly was a small New Jersey bank called the Commonwealth Trust Company. In 1958, he found this well-managed bank earning about $10 per share but paying no dividend, which caused its stock to be depressed at around $50 per share. Buffett calculated its true underlying value, what a private owner would pay for the whole business, at $125 per share. He saw a dollar bill selling for 40 cents. He didn't know when the market would recognize this value, but he knew the value was there. Over a year or so, he bought up about 12% of the entire bank. He was later able to sell his block of stock for $80 per share, not because he was a genius at timing the market, but because he had the patience to buy a wonderful asset at a ridiculous price and simply wait. Crucially, Buffett didn't believe in what he called the Noah's Ark school of investing, 2 of everything. He didn't diversify into hundreds of stocks. When he found a truly great idea, he concentrated his capital heavily. In his early years, he would typically have 5 to 10% of the partnership's assets in each of his 5 or 6 best ideas. Later, he even amended his ground rules to allow himself to put up to 40% of the entire fund into a single stock if he felt the odds were overwhelmingly in his favor. His reasoning was simple. Why would you put money into your 20th best idea when you can still put more into your best idea? As the partnership grew, however, Buffett's style began to evolve. The tiny cigar-butt companies were too small to make a difference for a larger fund. He also came under the influence of his brilliant partner Charlie Munger, who slowly steered him away from buying, quote, fair businesses at wonderful prices, and toward buying, quote, wonderful businesses at fair prices. This was a profound shift. He began to appreciate the qualitative side of investing, the power of a great brand, a dominant competitive position, and first-class management. This led to a new category he called generals, relatively undervalued. These were no longer just statistically cheap companies. They were great businesses that were temporarily out of favor. The two most famous examples were American Express and the Walt Disney Company. In 1964, American Express was hit by a massive scandal at one of its subsidiaries. Wall Street panicked, and the stock was crushed. But Buffett did his homework. He went to restaurants and banks, talking to customers and tellers, observing that people weren't stopping using their American Express cards or traveler's checks. He realized the company's powerful brand, its moat, was intact. The problem was temporary, but the business was permanent. He invested 40% of the partnership's capital into American Express, making an enormous profit as the company recovered. The second category of investments was workouts, what we would now call merger arbitrage. These were situations where a company had publicly announced a corporate action, like a merger, liquidation, or spin-off. Buffett would analyze the deal, and if he was highly confident it would close, he would buy the stock, which typically traded at a small discount to the final deal price. He called it, quote, getting the last nickel after the other fellow has made the first 95 cents. The returns on any single deal were small, but they were predictable, and the holding period was short. Compounded over a year, they produced very steady, attractive returns. The beauty of the workout category was that its success was almost entirely independent of the general stock market. Whether the Dow went up or down didn't matter. What mattered was whether the deal closed. This acted as a powerful stabilizer for the partnership's overall performance, providing a steady stream of profits that helped insulate the fund during down markets. The third and final category was controls. This is where Buffett's journey truly begins to foreshadow the creation of Berkshire Hathaway. Occasionally, one of his generals would remain cheap for so long that he was able to buy up a controlling interest in the company. At that point, he was no longer just a passive investor. He was in a position to influence or even direct the company's activities. He was no longer just owning a stock. He was owning a business. The most famous example from the partnership years was a struggling farm implement manufacturer in Beatrice, Nebraska, called Dempster Mill Manufacturing Company. Buffett started buying it in 1956 because it was absurdly cheap, trading for a fraction of its working capital. Over 5 years, he kept buying, and by 1961 he had control. The business was a mess. It had enormous amounts of unsold inventory, rotting in warehouses, and was barely breaking even. After trying unsuccessfully to work with the existing management, Buffett brought in a tough, brilliant turnaround specialist named Harry Bottle. Bottle was a force of nature. He slashed costs, sold off unprofitable divisions, and most importantly, began converting all that excess inventory into cash. And here is where Buffett's genius for capital allocation came into full view. As cash poured in from the liquidation of Dempster's unproductive assets, what did he do? He didn't reinvest it back into the mediocre windmill and farm implement business. Instead, he took that cash and used it to buy a portfolio of undervalued securities inside the Dempster corporate shell. He was converting capital from a low-return business into capital deployed in a high-return business. Within 2 years, he had pulled so much cash out of the operating business that he had recouped his entire purchase price, and he still owned the manufacturing operations for free. He then sold the slimmed-down, profitable operating business to another company, and was left with a corporate shell full of securities, which he eventually merged into his other holdings. The Dempster saga was a masterclass in how to think like a business owner and an investor simultaneously, seeing capital as a flexible resource to be deployed in its highest and best use, regardless of its current form. These three categories, generals, workouts, and controls, were the pillars of Buffett's operation. But running through it all was a fierce, unwavering intellectual independence. He made a powerful distinction between being, quote, conservative and being conventional. To many people, he explained, conventionality is indistinguishable from conservatism. If you own the big, popular, blue-chip stocks that everyone else owns, you're seen as conservative. Buffett argued this was dangerous thinking. You won't be right simply because a large number of people momentarily agree with you, he wrote. You'll be right if your hypotheses are correct, your facts are correct, and your reasoning is correct. True conservatism is only possible through knowledge and reason. For Buffett, a truly conservative action was buying something he deeply understood, where the facts were clear and the price offered a substantial margin of safety, regardless of whether anyone else agreed with him. In fact, he was most comfortable when others disagreed. He derived no comfort from popular opinion. As he famously said, a public opinion poll is no substitute for thought. This independent mindset is what gave him the courage to concentrate his portfolio so heavily. He believed that the idea of owning 100 different stocks, what he called the Noah's Ark approach, was illogical. He famously quoted the showman Billy Rose, who said, "You've got a harem of 70 girls. You don't get to know any of them very well." Buffett preferred to know a few businesses intimately and bet big when he found a rare opportunity. As the 1960s wore on, the market began to change. A new speculative fever gripped Wall Street. It was the go-go era. A new breed of performance fund managers emerged, like the charismatic Jerry Tsai, who traded hot growth stocks with what he called cat-like quickness. They weren't analyzing businesses. They were anticipating market action, and for a while, they were wildly successful. Buffett watched this frenzy with growing concern. The number of genuinely cheap, undervalued companies was drying up. Speculation was rampant. "We live in an investment world," he wrote to his partners, "populated not by those who must be logically persuaded to believe, but by the hopeful, credulous, and greedy, grasping for an excuse to believe." He felt increasingly out of step. His disciplined, value-based approach looked stodgy and old-fashioned compared to the high-flying funds that were doubling their money in a single year. The trickle of good ideas he could find was slowing to a drip. His growing capital base was becoming a drag on performance, and personally, the relentless pressure of trying to outpace the market was taking its toll. So, in May of 1969, at the height of the market mania and after a string of spectacular years, Warren Buffett did something extraordinary. He announced he was closing the partnership. He told his partners he couldn't find anything to buy that made sense, that he wasn't attuned to this market environment, and that he didn't want to spoil a decent record by trying to play a game I don't understand, just so I can go out a hero. His final letters to his partners are a masterclass in integrity. He didn't just hand them their money and say good luck. He offered to help them transition. For those who wanted to stay in stocks, he introduced them to Bill Ruane, a fellow student from Graham's class, whom he trusted completely. For others, he made a startling recommendation. For the first time in his life, he believed that the expected returns from stocks were no better than the returns available from safe, tax-free municipal bonds. He wrote a detailed memo explaining the math, and offered to personally help any partner who wanted to buy them. And finally, he distributed his controlling interests in Berkshire Hathaway and his other private businesses directly to his partners, giving them the chance to continue as his co-owners. He was closing the chapter on the partnership, but he was just beginning to write the story of Berkshire Hathaway. The 13 years of the Buffett partnership were a crucible, a period where he took the timeless wisdom of his mentor, tested it, refined it, and forged it into a philosophy that would change the world of investing forever. So what do we take away from this incredible journey back in time? The lessons in Warren Buffett's ground rules are, in my view, some of the most profound and timeless you'll ever encounter in the world of finance. What's remarkable is that they aren't about complex algorithms or secret formulas. They're about mindset, temperament, and character. The first, and perhaps most powerful lesson, is the importance of thinking for yourself. In an industry driven by herd mentality, where the fear of being wrong is often greater than the desire to be right, Buffett built his entire career on intellectual independence. He reminds us that true conservatism doesn't come from following the crowd. It comes from doing your own homework, trusting your own reasoning, and having the courage to act on it, even if it means standing alone. This is a lesson that applies far beyond the stock market. It's a call to cultivate a mind that isn't easily swayed by popular opinion, but instead is anchored in facts and logic. The second key takeaway is the power of playing the long game. In a world that's obsessed with quarterly results and instant gratification, Buffett's relentless focus on compounding over decades feels almost revolutionary. His stories about Queen Isabella and the Mona Lisa aren't just amusing anecdotes, they're parables about the near-magical force of patience. He teaches us that the greatest returns don't come from frantic activity, but from finding a wonderful business and letting the engine of compounding do its work, year after year, decade after decade. This requires a fundamental shift in perspective, from that of a trader to that of a true business owner. So, what can you do, starting today, to apply these principles in your own life? Let me offer just a few simple actions. First, start seeing the world through the lens of an owner. The next time you buy a coffee, look around the shop. What makes it successful? What are its costs? Who are its competitors? The next time you see a popular product, ask yourself, what's the business behind it? Is it a great business? Why? Cultivating this business owner mindset is the first step toward becoming an intelligent investor. Second, embrace the idea of Mr. Market. The next time you see the stock market plummet and the headlines scream of panic, take a deep breath. Remember that Mr. Market is just having one of his bad days. See it not as a threat, but as a potential opportunity. Train your emotional response to be the opposite of the crowd's, to be greedy when others are fearful, and fearful when others are greedy. Finally, start your own compounding machine, no matter how small. The most important factor in compounding isn't the amount of money you start with, it's the amount of time you have. A small amount invested today has the potential to grow into a fortune over a lifetime. The key is to start, to be consistent, and to let time work its magic. That was a summary of Warren Buffett's Ground Rules by Jeremy C. Miller. We've journeyed through the core principles today, but I'll be honest with you, a summary can only ever be a map. The real treasure is found when you explore the territory yourself. The true magic happens when you read the book, when a particular story or a simple phrase from one of Buffett's letters connects with you in a way you didn't expect. This summary is designed to help you decide if this journey is one you want to take. If anything we've talked about has sparked your curiosity, I urge you to grab a copy. Reading it isn't just about learning finance. It's an experience that can genuinely change the way you see the world of money, business, and even your own potential. Also, if you found this summary valuable, please consider liking this video and subscribing to Billionaire's Bookshelf. It helps us reach more people who, like you, are on a journey to grow wiser and wealthier. Let's keep turning the pages together.